Good afternoon. This is Mike Bertelsen, the Bear Market Investor, with the market update for February 10, 2011. We're here looking at the S&P 500 stock index in the 5-minute time frame. We're also going to be looking at the volatility index as well. First, let's go ahead and jump into wave structure. Over the last couple days, we had an interesting ride here. And there is no clear explanation for sure to explain exactly what's transpired here. We did break below a fourth wave low. So we did confirm a short-term reversal. And we had follow-through to that this morning. However, the possibility that we entered a third wave was negated by the fact that we have since broken back above where that started, and we even broke back above this last wave top right here as well. So there is a possibility, however, that we had an ending diagonal. That ending diagonal could have ended here or here. In a case of where it ended here, we may have had an expanded or irregular flat correction, which would be in the form of a 3-3-5. However, trying to get 5 waves out of this is a little bit difficult because of all of the wave overlap. However, it does look pretty good as a possible ABC, X, ABC, suggesting that maybe, just maybe, we had a double zigzag. In such a case, that would mean that we probably have just about topped out, if not already, and that we should start seeing a decline happen soon. Now, this is all up for speculation here at the moment because, again, the only confirmation we have is a break of this prior fourth wave low, which is a start. But until we get into a further developed wave structure, it is very difficult to say exactly what the next couple days are going to look like here. Now with this was exactly the same issue here that I had. While I was able to count everything up until this point, once we started getting into this, it became pretty difficult for me to not have a situation where we had wave overlap. In this particular case, it looks like we may have had an ending diagonal, leading into the conclusion, perhaps, of wave 5 of C. Now, tomorrow will be interesting because what we don't really want to see is a break of this prior top here. We want to see further selling in the market tomorrow. Now, if we do get a brief push up, perhaps that's okay as long as it ends somewhere below this peak. Now, we're not very far away from that. We're above the 78.6% retracement and below the 90%. Some counter waves do in fact end up towards that 90%, maybe even higher. So it's not out of the realm of possibility that we actually do get a push up into that range, but still fall short of that prior peak. If we do get a push above that prior peak, that's also going to be an interesting case for debate as to what exactly that means to this overall wave structure. Now let's go ahead and jump into the 2-minute chart so I can show this in a little closer detail. Now we're looking at the 2-minute chart here of the S&P 500, and what I'm going to show you here is just how messy today was. We had this absolute cliff dive that we took right away in the morning in form of a very, very steep sell-off. Now at first, it seemed fitting because the possibility that we may have been entering in a third wave meant that we could have seen some sharp selling take place. Fortunately, we did find support, and we moved back up here, cresting this peak and cresting this peak by a fraction of a point. After that, we saw some weakness in the indicators, but not any substantial selling. In fact, as you can see, even in the 2-minute chart, we had a bullish divergence here in the stochastic, meaning we had a lower price point, but we had a higher low in the stochastic, and we had a higher low in the RSI. That usually suggests that a counter trend is going to erupt. Even in the big time frames, same type of thing into the March 2009 stock market low. we had similar divergences take place there. You better darn well watch those no matter what time frame you're in, because they usually signal a reversal in trend. And so we did get that. We got a little rally there, a little sell-off, and then another sharper rally, followed by a sharp sell-off, followed by another sharp rally. Just all over the place today. But what I want to say here is that if we had a leading diagonal, and if that were to have ended at this point, and we were to have had a regular or an expanded flat correction, that would have to be 3, 3, 5. I can't really make this out to be 5 waves. I've looked at it, and I've looked at it, and I've looked at it, and I can't do it. So my guess is that's probably not it. We probably had a leading diagonal that ended at this level right here. I can't find any way else to slice it and dice it. Now, what's interesting about this counter trend here is, let's take the other side of the fence for a moment. Let's say that we were bullish on the market and that we believed that this sell-off until this point was just a correction. Okay? The problem with that is we might be able to make or suggest that we had a 5-wave push here, even though it doesn't quite look right. It looks like an ABC. But then we get this correction here, which we would say then is a second wave. Then of a third wave, we start that, first wave, second wave, third wave, oops, steep sell-off, and, by the way, wave overlap here. We can't do that. In fact, we can't even say that this is wave 1, this is wave 2, this is wave 3, this is wave 4, and this is wave 5 because we just overlapped that wave again. Likewise, we can't say this is wave 1, this is wave 2, this is wave 3, this is wave 4 because we just overlapped that wave again. So no matter how we slice this and dice this, I can definitely not get a bullish count, especially at this point in time, out of this entire rally that we had here. The leading diagonal still looks like our best bet here. I'm leaving the irregular or expanded flat correction out of this because I just can't find any way of counting this at the moment. In any case, regardless, if this is a correction, we want to see this end very, very soon, if not having done so already. You know, if it goes up to 90%, fine. If it goes up to 99%, fine. We do not want it to break that Tuesday peak in the stock market. We do not want that to happen because that's going to bring into question a whole lot of different things. You know, how do we make a bullish count out of this, perhaps? But what was this whole, sell-off right here, and how do you make that out? But then also, what was that fifth wave ending diagonal? None of that would make sense if we actually did crest into a new peak, unless perhaps it were done at 2 degrees higher than that fifth wave that ended in an ending diagonal. But even that's still hard to buy because we didn't sell off that much into this point. It wasn't like, a really big sell-off. It looks big here because we're looking at a 2-minute chart, but, in reality, we need to see a lot more selling take place here in the near future to help confirm that bearish perspective on the market, and that in fact a top had been put in place for more than a short term. Again, big picture, we want to see all those fourth wave lows taken out. We want to see that broadening top formation confirmed, and we want to see this rally stop right here. Or maybe, I'm not saying this would be a good thing, but maybe with another brief surge up if that were to happen. But regardless, we do not want it to crest much beyond this 90% area. Certainly not be on that Tuesday peak in the stock market. Now let's go ahead and look at the volatility index. Now we're here looking at the volatility index in the daily time frame, and what I want to point out here is today we got another red hollow candlestick. That is where we gap up and close down. The exact opposite of this red hollow candlestick, as you can see here, is the green filled candlestick. These types of things you'll usually see at tops and bottoms. The green hollow candlestick is fine. That's actually a normal candlestick, as is the solid red candlestick, okay? But a candlestick like this suggests a trend reversal. These suggest trend reversals, and the volatility index getting a higher close, yet the stock market also closing up on this particular day in such a rare occurrence also suggests that a change in trend is taking place. So we need further confirmation here. We need to see that surge in volatility. Now, if we can expect that the S&P 500 is in a counter trend rally and that the larger degree trend has changed from up to down, and hopefully over the long term from the bearish perspective, then we should see that eruption in volatility. So just again, more signs that suggest that we are bottoming here in the volatility index and about to surge to the upside.